We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation. You can listen to our conversation on the desktop, but it works better on the mobile app. Just as a reminder, you can follow us on Twitter at Palisades Radio, as well as on YouTube, Spotify, Apple Podcasts, Rumble, and Odyssey. And if you find today's episode valuable, please take a moment to like, subscribe, and share it. It helps us reach a wider audience. Now on with the show. Hopefully everybody's surviving the cold as as it affects them. I know for us here, I'm in Alberta. It's almost minus 40 with the wind chill, and that's for both Fahrenheit and Celsius meet at minus 40. So it's pretty hostile outside. David, did you want to start, or did you want to wait for Bix?
Kind of like to give them a few more minutes.
Get everybody a couple minutes.
Yeah, I'll give them a minute or two. You know, I could be long-winded, and I'm probably going to be somewhat long-winded on this one because there's so much. But
what do you mean? I thought you just wanted to spend a couple minutes going over it, and that was going to be it.
I hope so. That's my wish. We'll see what happens.
All right, we've got everybody in here that we wanted to have. So, David, if you want to start, Bix, you can hear us and speak.
I believe I can. I didn't know we had to go mobile, so sorry for the delay.
All good. It's kind of a weird platform for that, but thanks for joining us, Bix. I appreciate it. David, did you want to kick us off?
I'm ready to start. So, welcome everyone, and thank you, Tom, for bringing this about. Appreciate you honoring the request. So we're going to talk a lot of things. I've got a hard stop at 4:30, and someone asked about the Lode project in a direct message to me on Twitter. I will just briefly mention that right at the start so I don't forget. I am an ambassador, so I have silver that I contributed to the program, the initiation of it basically, and then after a year and a half or two, I decided to add to my position. So I am biased, but it is a gold and silver tokenized on the blockchain system. And we just implemented a silver stream token that allows us to get silver under spot because we're getting it in that in-between space from the concentrate from a mine into the refinery. So there's a gap there, and there's always a profit to be made, regardless if the miner that delivers the concentrate is, mining that under cost, under all-in sustained cost, or over. Doesn't matter, the refiner still gets their cut. So we've established that recently. If you want more information, just go to ag.lode.one. You can have any URL these days. So it's symbol for silver, ag.lode.one. Scroll down to the bottom and watch the 3-minute video called Imagine. Imagine talks about imagine having real money in your account, imagine peer-to-peer, all the stuff that most of us know that have looked at the blockchain or the crypto space. So moving on to start this off, we did this because there's been a lot of talk on the web and all over different channels about what's really going on at the mint. And I got a hold of Tom Power and asked him if he would be willing to do an interview with me, which we did. That could be looked at on the Wall Street Silver channel. And I won't even review it. You can listen to it and make up your own mind. We might talk about it later. But basically, I was saying first of all, let me establish this. I believe that the mint should meet the public demand. So I want to be unequivocal about that. The mint should meet public demand on Silver Eagles. And they mandated that for a long time in writing. Whether or not they actually have met that, you can make up your own mind. I mean, there's several years they probably could have sold more than they minted, and at one point they finally ramped up their production. It used to be 10, 12 million ounces a year when there wasn't really that much demand. And when demand really soared, they increased their capacity and they got up, and I don't have the numbers in front of me, but I know they had over 40 million ounces a few times. And then, of course, last year or this year, it's been pathetic and the premiums have gone through the roof, which we'll talk about more. But I want to be clear that I think that the mint should meet demand. And I was on board with the law as I'd read it earlier on that said that that's the case. And then my friend Bob Coleman called me up and told me in a polite way I was wrong. I said, well, okay, I've been wrong before. There's no reason to worry about being wrong or making a mistake. It's human nature to make mistakes. Defending mistakes, that's what will get you in trouble. When you've got to be right no matter what all the evidence points to, then that's an issue with the individual self or group or whatever. So coming back, Bob said, the law was changed. I said, okay, show me, and he did. And I won't read the whole thing, but the gist of it I'll read right now. And again, I just, wish that things are different, but they're not. So, and I've got a reason for this. I'm going to read it. I'm going to make a comment and I'll turn it over to the floor. But at the request of the United States Mint, so this is stating that it came from the Mint, a bill with a legislative fix for a problem was introduced known as, quote unquote, the Coin Modernization Oversight Continuity Act of 2010, end quote. So the Mint requested a legislative fix for a problem. The bill was passed in the House of Representatives and Senate and is public law number 111-302 with President Obongo's signature. Under the act, the previous requirements related to the issuance of American Silver Eagle bullion coins was changed. The new requirements call for the Secretary of the Treasury to strike the coins in both quantities and qualities highlighted that the Secretary determined to be sufficient to meet public demand. The purpose of the change was to allow proof silver eagles to be produced even at times when bullion coins were not being minted in quantities needed to satisfy full public demand. So that's really an interesting legal situation because I called BS on it when I talked to Greg Hunter about it. Because what this says is that they could put the bullion coins on hold just to make certain that there's enough proof coins available to meet demand, which is a microcosm of what the total demand is on Silver Eagles. The proof coin demand, I don't know the percentage. Bob might. I could look it up. I don't have it in front of me, but it's very small. And what's interesting is when we interviewed Tom Power is that the planchettes or the blanks requirement for the mint is that it is of such a high quality that you can strike proofs with that planchette or blank. And so they use the same exact blank off the shelf if they're going to strike a proof coin or a bullion coin, same one. So I think that's it. I mean, I don't need to overstate it. I think that's enough. And I'll just turn it back to you, Tom, and we can take it away.
David, maybe real quick, what's the difference between the proof and the coin?
The proof is usually...
Or the blank.
The blank is no different, but when it's struck at the mint, usually there's a limited amount. The dies are polished better, supposedly, and when they strike them, they usually punch them twice, so you get a deeper impression, and then they're deemed to be proof quality, and they are. And that's what the mint sells at a high premium. Of course, we're going to be talking premiums the rest of the night. But it's coin collector coins, basically. A proof quality coin is something that a coin collector wants. And someone might want one for a gift or something like that. But generally, it's a coin collector market. So they are struck usually 2 times. They're usually with dies that can only do a proof coin so many times. Whereas with a bullion coin, they can run the dies longer. So the impressions, but they have a very high quality standard at the mint, as you would expect, because it is a representation and it's legal tender. of the U.S. government. So, the quality on any Silver Eagle is very good. And that's a whole subset I won't go into. But I think, did that answer the question?
Yeah. Thanks, David. I guess, why did this come up, and why is it maybe a point of contention?
Well, I don't like to speak for others or even get into intent, but Bix, the way I heard Bix, because I don't want to misstate it, was that it didn't change anything. And I could kind of stand on that side. I mean, if you read it, as I read, it says that the secretary has to strike it, to meet public demand, but she's in charge, or he, or whoever is the Secretary of the Treasury. And the purpose of the change, I mean, it's so ridiculous. But anyway, you could take a thought experiment and say, there's only, so we're only, at about 16 million Eagles this year, I think. So let's say there's only 1 million available. Okay, take it down to 1/16 of what we have now. Then the Secretary of Treasury would say, well, there's a demand for 1 million proof Eagles. So that's all we're going to mint this year. We're not going to mint any bullion coins whatsoever at all. I mean, again, it's just kind of ridiculous. That's how it reads. To me, it's an excuse, but it does exist. The law is there. There's no question about that. What was the intent? Well, I'll go one step further and speculate a little bit. Let's say that Bix gets a contingency of pissed off Silver Eagle owners or wannabe owners, and they do a lawsuit against the mint because they are supposed to meet public demand, and they go into court as a class action. And then they pop this law out, 111-302, and they ask the Secretary of the Treasury, well, what happened here? And it's Janet Yellen, we know who it is presently, would say, well, I had to make sure that there were enough proof Eagles. And so we had to slow down the production of bullion Eagles, which is, of course, absolutely ridiculous. But that's what it says. So I'll turn it back over.
The odd thing, Tom, is that the mint makes money on every coin. There's very few things that the government does that makes money. They make money on every coin. You'd think that they'd produce whatever they wanted to generate some cash flow. It makes no sense.
Yeah, that's fair, Jim. Bix, do you have anything to say back to that? Like David said, you said it didn't necessarily change anything.
Yeah. A little background. I've been doing this since 2008, this same subject. I've written the mint 4 or 5 letters. A bunch of us, 1,000 of us, got together and wrote letters to the mint in 2008 saying, hey, according to the law, you shall create coins sufficient to meet demand. And then they added this other part, which this is the first I heard about the proof coins, although they specify proof coins in a different part of the Silver Eagle law. But a few things stand out to me. And number one, the U.S. Mint should not be making any money on the silver and gold Eagles. That's specified in the law, exactly how much they should sell it for. It's right below in section F. It's basically their cost plus the market price of silver at the time. There is no markup that should be made on just the bulk Silver Eagles or gold Eagles. Now the proofs, they can mark those up to anything they want, and they actually do. If you look at how much they charge for a proof Silver Eagle, it's off the charts. I mean, for me, it's the same story that we get the runaround from the mint. They never have ever claimed that they have or have not made coins to meet demand. As a matter of fact, I did a FOIA request back in 2013 after this part of the law was inserted where the secretary determines. And I said, okay, Mint, if that's the position you're taking, please send me all the correspondence that the secretary sent you on this matter. And also tell me about your hedge book and all the correspondence you have about your monster hedge book that the Mint runs. And I got the FOIA request back right away saying, we don't have to do this fast. We could take our time. And 3 months later, I got it right here, still from 2013. The answer was, and my question was, specific, all correspondence within the last 6 years from the Treasury Secretary to the U.S. Mint regarding suspending, rationing, limiting, or curtailing production of the coins. And the answer was the United States Mint maintains no records that are responsive to your request. So, I mean, this runaround has been going on for so long. They cannot and should not, according to what the law says, even do any kind of rationing at all. And this has been going on since 2008 is when they started doing it. It is just at this point in time, when silver is finally breaking free of price manipulation, we have the literally worst performance by the U.S. Mint in at least 20 years, probably since the program started in 86. They could only make 16 million coins when their production capacity is clearly well above 50. I got a letter from Ventures Gibson, the head of the Mint, saying we have expanded our silver eagle capacity, and then she only does 16 million coins this year. I mean, the whole thing stinks to high heaven, and it has stunk for the 20 years I've been in it. And the only way to get through to these people is to not let them get away with it. Just keep harping on them, and they'll get to the point where they can make 47 million silver eagles. They did that in 2015. They have the capacity to do it, at least that. And Ventures is saying they expanded that capacity. So something else is going on. And I think a big part of this also has to do with their hedge book, because they're supposed to just be hedging coins that they buy. They get the metal in, they put on their hedges, and then when they sell the metal, they're supposed to close out the hedge. And that works great. It's worked great for the past 10 years, because the years that the price of silver goes up, they're going to cover that or they'll lose on their hedge book, which is what you're supposed to do. So you break even. You don't make money on the rise or fall of the price of silver. The problem is last year, they ended up with a loss of $77 million. And the price of silver had gone up a little bit, but not that much. And then that was 2000. In 2001 was the big one. The price of silver went down, and the Mint lost $112 million on their hedge book, meaning they aren't doing what they're saying they're supposed to be doing. And I have another FOIA request in for that, but I'm not holding my breath on that one. That's where I am in this mess.
It's really interesting, as you're saying, Bix. The hedge book shouldn't necessarily be overly difficult to run. Number one, and number two, the fact that they made 7 years ago, they made 47 million eagles, and this year they only made 16, if I'm not mistaken. So
with the 80% premium
capacity. So I guess one point that we haven't really touched yet is, what does demand look like at this point for eagles that you feel like they're maybe not meeting?
Well, from my perspective, there's absolutely a massive demand. People are actually paying these amounts, the 80% premiums for the silver. I have a lot of customers who are saying, should I buy silver? And I'm like, I mean, silver eagles, I can't recommend them buying silver eagles at an 80% premium. And the other thing I tried to figure out is how much more gold had been sold, gold eagles had been sold, because usually if people like that, Andy Schechtman had a huge order for $50 million, and the person wanted all silver eagles, but he couldn't get them. So he had to go over to gold eagles, as well as some pre-65 coinage. But I mean, that order right there is $50 million worth of silver that I think it was only like 20 million or 25 million that he could fill with silver eagles. So, I mean, just on that one customer, it's a huge difference compared to what's going on at the Mint. And they really don't talk about it at all.
Yeah, that's, like you say, it's if nothing else, that's very suspicious. Maybe Bob or David can talk a little bit more to the premiums and where those premiums are actually coming from. Who's charging them? Because as I understand, it's not all the Mint, right?
Yeah, the Mint can't. They legally can't charge a premium.
Mm-hmm. Bob, if you want to take that over, talk a little bit about premiums.
Yeah, we can get into premiums. I want to just clarify something on this hedge book, because the U.S. Mint actually doesn't hedge, or at least they didn't hedge. They have a procurement department as well as the Mint's department. Anytime they sell gold or silver in the eagle form or coin form, they have to replace the gold or silver at the moment that they sell eagles or buffaloes, whatever it may be. They're not really hedging. They're just simply replacing. And the procurement department acts separately from the U.S. Mint's department, which he had, for example, in 2021, in the summer of 21, the procurement department went through a audit, and they had to stop the activity of procuring gold and silver for, I think it was for about 3 weeks or something like that. And that got into the market. And so all of a sudden the prices of Eagles had a little bit of a bump up in premium because they didn't have clarity of when they would start buying more metal again. Everything I know about the Mint's program, there isn't any type of hedging that goes on. It's just simply replacing metal once it's sold into the market.
Well, the annual report lists what they do with their hedge book, and it's only silver Eagles that they're hedging. Just silver, not gold, not platinum, not palladium. And I got it right here, number 19 in the 2001 annual report. Mint recorded net losses of $111.7 million on its silver forward contracts for 2021, compared to net losses of $72 million in 2020. So in another part, they go through why they do the silver hedging, because silver is so volatile, and according to the law, it says they can't make or lose money. They have to sell the silver Eagles at the price of silver plus what it costs them to make.
Yeah, and that gets us into the premium and the industry. And this is what I've been almost screaming from the rooftops on, is the way the industry is structured. Starts with the authorized participants and the wholesalers, and then it goes to the retail dealers. And so in 2020, in 2018 and 2019, you couldn't give this stuff away. I mean, it was to a point where you could buy a gold Eagle literally when you were selling back to wholesalers, they would buy them at a discount to spot. It was that bad. And then, of course, COVID happened, and all of a sudden, the demand for the Fed prints money, that everyone starts going bonkers over assets in general, and especially the gold and silver market picked up. And then what you kind of saw was when you had the blowout between the COMEX and the LBMA or the London spot prices, and you had that divergence there. I saw a lot of retail dealers starting jamming premiums up, premiums that I've never seen before. It was so bad that we were selling product $2 to $5 an ounce of silver, $2 to $5 cheaper than every online dealer that was out there. It was so chaotic. And then 2021 comes around, and you had the silver squeeze in February, and then the wholesalers decided to bump premiums and play that game. And you started to see really fat premiums on retail product, but it was not only being hammered by the retail dealers overcharging for product, but also the wholesalers getting into the fray of starting to charge higher premiums. And so where you walked into the summer of this year, you had that big order from, was it Miles Franklin? They talked about buying $27 million in silver Eagles. I think the industry on that trade alone, the $27 million, I calculated that the industry, including the retail dealer that sold the product, made about between $10 and $12 million in commissions just on that trade alone. It was painful to watch. And most investors out there don't understand the premium game and how these premiums can float upward or downward. And so what happened was that created a shortage of Eagles. And all of a sudden, you started to see the wholesale market not only raise their offers, but raise their bids, because now they needed to get product because they had people interested in buying the product. And so that started pushing premiums up. And you got into this sort of frenzy almost. I mean, to give you an idea, APMEX, which is an authorized participant that can buy directly from the U.S. Mint, the U.S. Mint sells silver Eagles at $2.95 over spot. Why these authorized participants are selling those products for $10 and $12 or $14 over spot is beyond me. That between that $2.95 and that $10 to $14 or whatever that number may be. I mean, now it's collapsed. I mean, the whole market, the premium structure is in complete free fall because I think people are just burned out. But that's where a lot of the markup came from, was a small group of players, basically, which had, they're like ticket scalpers. They can buy the tickets directly from the band, and then they go out in front of the stadium and sell them for whatever they can get them for. It's not the Mint the premium issue. It was really the authorized participants buying from the Mint. Now, to take a step backwards, though, the U.S. Mint is not the problem here. I think everyone's missing the point. The U.S. Mint actually hires out vendors to make these blanks. There's only basically one vendor that makes the silver Eagles for the most part. And they made a conscious decision back in 2020, and we can go through this story a little bit, but they made a conscious decision to start making less Silver Eagles. And it goes in correlation, or a big wholesaler, which is also an authorized participant for the U.S. Mint, decided to start buying and taking an interest in Sunshine Mint. So the company in question is A-Mark Precious Metals. They're one of the biggest wholesalers in the business. And they were buying other gold dealers. They've invested in, they own JM Bullion and Provident and Silver Gold Bull and a number of these other dealers. And they vertically integrated into Silvertown and was it Gold Line? I think it was, the retail dealer. But they started buying a lot of the participants in the industry. And they have a 45%, I believe, interest in Sunshine Mint at this point. A-Mark also has proprietary product that's made by Sunshine Mint. So it doesn't take a rocket science to start following the money here and realize if you can make less Silver Eagles, because the Silver Eagle is the prominent product in our industry. Everything is pretty much predicated off the Silver Eagle in terms of premiums, because the Silver Eagle is the most popular product out there. So if you can curtail the production of Silver Eagles and you start making your own proprietary product in replacement of these Eagles, you can then charge more for your proprietary product. And that's exactly what took place over the last 2 years. And I think the very frustrating on my part, it being not only a hedge fund or a fund manager invested in precious metals, but also one that buys and sells metals. We store metals in our depository. The idea is that I look at this from an investment standpoint, and these premiums started to make these products almost not like investments, but just simply retail products. You're having to overcome a massive premium just to break even. And so, and I think the last couple of years, I think Sunshine Mint could have been a hell of a lot better in terms of being forthright of why they were making less blanks. I mean, you had a lot of finger pointing going on saying the Mint Mint couldn't get the silver, the US Mint saying we got the silver, we just can't get the blanks made. But in reality, if you just follow the money, there was just less blanks being made because it just wasn't as profitable to make those. It was more profitable to make proprietary product. And it was like the best of all worlds. It was like the perfect storm. The proprietary product premiums went through the roof, and all of a sudden you had basically, I don't want to say like a gold mine, but you basically had a money-making machine off the lack of production from Silver Eagles.
I've heard that. Tom Power said that, the head of Sunshine Mint, and it might be part of it, but it doesn't explain what happened to the Mint in 2020, 2021, or especially 2022. Because 2020, they made almost double the amount of Silver Eagles. They made 30 million in 2020. 2021, they were on track to do 33 million, except they had the month and a half shutdown to get the new put the notch in the bottom and the new back on the Eagle. But then 2022 is a completely different world. I mean, you went from making 30 million to 28 million, and then you dropped to 15.9 million when the premiums were up there. I mean, there is no, and that's after COVID. There is no excuse for that. And the Mint lost $112 million in their hedge book in 2021. I mean, there can be no excuse for making 16 million Eagles this year with the popularity going through the roof.
Well, just look at A-Mark's balance sheet. I mean, their income statement. I mean, it's if you want to look at a correlation there with lack of Silver Eagle production and the massive profitability of selling other product,
right.
It's right there.
You're right, but theoretically, out of all the retail buyers in the world, the U.S. Mint should have the most power to, especially because they were only getting them from Sunshine. Sunshine expanded capacity to 90 million blanks that they were making. I mean, it makes sense.
But Sunshine started to take on the South African Krugerrands that were distributed here in the U.S., the British Britannias that were distributed here in the U.S. They started to take those accounts on. They were making proprietary products. I mean, they started taking on other business. The U.S. Mint, and even I think Tom Powers mentioned that they wanted to diversify from the U.S. Mint being the largest client into a wider array of clients. Well, when you do that, you can only make so much. The problem the Mint has is the Mint the mints should be making their own product personally. I mean, they have enough. The U.S. government, it's not a question of money. I mean, they can buy all the equipment they want. They're at the mercy because they vendor out all these blanks that are being made. They don't have their own capacity that they need. Yeah. That's the problem.
There's also the fact that the U.S. Mint is the only mint, I believe, in the world that is mandated to make these things no matter what the cost. So they literally have to pay whatever it takes to meet public demand, even if they have to pay $10 over spot to get the blanks from Sunshine. Now, Tom Power didn't say how many the mint was taking from him, so we don't know. And the other vendors that they're building out, we don't know. I do have a letter from Ventures Gibson saying there's, and I quote, "We significantly increased production quantities of our most popular coins, the American Eagle 1 ounce silver dollar." And I'm like, well, Ventures is new to the job. She's never been in a mint in her life. But when she joined the mint in October of last year, that's when the huge drop down happened. Literally they're going to do less than 50% of last year. That's not acceptable.
It may be 16 million coins to her is a lot of coins.
It is true, from 0 to 16.
Yeah. I think, not to say that the government they're always perfect. They're not. But the problem that we run into is we live in a world where it just seems like there was a lot of industry players taking advantage of these premiums. And as you see a company that grew and bought out a lot of players, vertically integrated, just the fact that A-Mark, who's one of the largest authorized participants, was allowed to purchase up to 45% interest in the mint manufacturer of these blanks, they could actually tell the order flow. They could get a gauge of what other authorized participants were doing. I mean, if you were a savvy attorney out there, class action attorney, the question is, could you make the case of almost the authorized participants having some type of constructive corner on the market in a way, because they're the only ones that are allowed to buy these bullion the silver bullion coins. And one way to kind of thwart that would be allow the public to be able to buy these things. Of course, it would be a nightmare, probably logistics wise, but open this thing up a little bit more where you're not as dependent on a few players out there. And it would also leave these players from having to take inventory, because at the same time, in all fairness, they have to take inventory when times are lean. And like we're seeing right now, the demand for gold and silver products has fell off a cliff right now. I mean, you have the 2023 Eagles that are getting ready to come out in the second week of January. And I think from what I kind of hear out there is that demand for these things is just not there. It's abysmal, because I think
the premium scared everybody away. It's a little catch-22 also when the U.S. Mint isn't producing, for whatever reason, isn't producing the quantity that will meet demand, which is clearly it didn't do that. And whose ever fault that is probably is, it's the guy who has control of the coins after the mint, because the mint's required to do a certain amount. But they are required. They're the only party in this whole thing that's required to pay whatever it takes to get these coins out to meet demand. And if it takes them going to, buying out the Sunshine Mint completely and totally and saying, okay, all your production is coming to us, that's what they would have to do by law. But they did. They used to make the blanks before they contracted with like Sunshine and other mints. So they can bring it in-house.
Mm-hmm. Yeah. Problem we're running into now is I think a lot of players that run refineries and minting operations, or they look at the amount of investment that has to be done in terms of buying the equipment and so forth. And of course, like you said, the tolerance for these Silver Eagles are second to none. I mean, they're a very high quality product. The issue is someone willing to invest a crap load of money knowing that they're not going to be able to start making this stuff probably for a year after they make that decision they want to start making the stuff. And by then the question is, what happens to the premium game if it does collapse? So that, of course, then you have the supply issues and constraints of being able to get the equipment. If equipment breaks down, replacing it. And of course you have these stupid social distancing issues and all that kind of stuff that created even more frustration in the production of the stuff. But that's the industry. It has a lot of problems in it. And then on top of that, you had the price of silver go down to a level where you started seeing mines starting to roll forward their forward contracts because the price was too low. They weren't making any money by the time they factored in their production costs. That can lead us into other things with regard to the bank derivatives report, all that kind of stuff. But it's a big problem in the industry that I've tried to point out a lot of times. And it seems like the dealers out there, the retail dealers, don't want to sort of spoil the apple cart because the premiums are so fat and the profit margins are so big. But like I mentioned last month, I said the profit margins peaked. I mean, I think we mentioned that on the last Spaces thing we did. And they have. The premiums have just collapsed. The junk coin that was selling for $10 over spot, selling that thing, I think it's like $3.25 or something like that over spot now for junk coin. I mean, it's the bids on these things are 50 cents over spot. It's happening in multiple different products.
I think a lot of my customers are basically seeing these monster premium and said, I can't do it. I can't spend 70, 80% getting coins when I can get, I'll just go to 100-ounce bars until everything cools down or something. Or I'll sell my Eagles and buy even more silver. Or, the reality, the biggest thing that should upset everybody right now is that the mint isn't providing the product to meet demand. And demand was there while the premiums were spiking. If you're going down now, great. But you had a whole year and a half where you practically did nothing. Ventress Gibson came in. It's been a year and a half. She literally has done nothing to promote she promotes the other products a lot. She loves all the theme type coins that they do, but their number one seller, the Silver Eagle, it has been languishing under her rule. And I have no doubt that Janet Yellen told her, hey, we can't make a lot of Silver Eagles because we just don't have, at this price, we can't find that silver. And that's a problem with pricing.
Yeah. Well, you got to remember too, the retail dealers aren't going to bitch and complain when they buy a round or have a round made at 50 cents or $1 over spot is their all-in cost, and they're selling that round for $5 over spot. It's benefited the industry to a point where the industry isn't going to speak out against this.
I shouldn't complain either. My number one holding has been Silver Eagles for the last 20 years. And so, I mean, it benefited me. Yes, I did sell a few Eagles because it was just so crazy. And I sold them like $10 over spot. I'm like, who in the hell is buying Silver Eagles at these prices? Especially when the price was below $20 for silver. The big problem comes down to it's an inefficient market because the prices are rigged so low every time by these goddamn banks. We need to remove banking from this business. The bankers have a license to print money for free. And they're abusing this license by abusing the metals markets, the stock market. They're just massive riggers. And if we're going to give them the ability and the license to print money for free, we got to keep them out of the metals market, the commodity markets, the derivative markets. For Christ's sake, JP Morgan has 55 trillion in derivatives right now? Why not say 55 quadrillion or Google 55? It's just insane. There is no limit when it gets this out of control, and it's going to end in tears. And I think pretty soon.
Well, the derivatives report, we can get into that too a little bit. Bank derivatives report is really a total notional value report. Because I know you look at that. I've looked at that a lot. Like you've seen this big drop, I think, this from the third quarter, from the second quarter, in some of these banks. If you have $37 billion in precious metals derivatives, for example, that's basically notional value, and it's netted where you have supposedly it's a notional value where it's both buys and sells. It shouldn't really have a much exposure. The issue, for example, when you buy an option, for example, call option that controls 100 shares of stock, and you put down $100 controlling $10,000 worth of stock, the notional value of that contract is going to be listed at $10,000, even though you only have $100 invested. And that's part of what some of the issue is with these OCC contract, the bank derivatives reports, because you have to look at the banks also create a lot of derivative products. And so, and this is something I kind of got into earlier this year when you had, some of these are really crazy products, but you had like contingent buffered return enhanced notes linked to the iShares Silver Trust, for example. that's a derivative that's created by Bank of America or JP Morgan that gets thrown into the silver category, even though it has absolutely nothing to do with the silver metal itself. And that's part of why this OCC report, it's kind of laughable sometimes because it really doesn't have anything to do with the metal. It's all about financial products and derivatives.
I think it really did have a lot could be gleaned from it before they changed how they report. They put gold in with other precious metals in the beginning of this year to hide that Bank of America literally took out $1.2 billion notional, in derivatives in a matter of 18 months. I mean, there is no justification for that. I don't care how many derivative products they sell. B of A wasn't even a very big player in silver until a year and a half ago, and then all of a sudden everything blows up. I think we are headed for another blow up, and it's because look at the derivative mortgage-backed securities and the credit default swaps. It's all notional until it isn't, like in 2008. Everything was notional until all of a sudden a couple counterparties failed, and it's over, and everything counts then.
Yeah, I mean, I get what you're saying there. The banks, the reason why they rolled gold into the precious metals group was they were taking it out of the exchange rate category. And I think part of that was due to the Basel III idea of addressing the liability concerns on the balance sheets of these banks, which it does distort, obviously, the category because you see the ballooning of numbers because you're moving gold, which was obviously weighted a lot more in terms of holdings. It's a much more mainstream asset for central banks and bullion banks to use. But I think part of that also was, you were into a negative interest rate environment at the time, or zero interest rate environment, and gold, it was being recategorized as more of a commodity than it was any type of currency at the time, because a lot of these currencies their debt was negative yielding or yielding almost zero. So there may be some structural shifts to reweight gold into the other category. Plus you had gold was actually being moved around from commodity trading desks to equity desks. And it was some of the banks are actually getting out of the commodities business and, getting out of the gold trading business as well. I mean, it was kind of a big mess the last couple of years, but the banks actually do provide a high degree of liquidity for a lot of players in the market that are forced to hedge. And a great example is a lot of retail dealers out there and wholesalers hedge. I mean, they sell futures contracts on the market because they may have a line of credit that the bank has been willing to grant them. Part of that responsibility of borrowing money to carry your inventory is you have to hedge the inventory so you don't have any price risk. That's part of how you just run a business in the industry. So banks do provide some good business sense in this environment, but I think the problem you run into is when they create a lot of this literally garbage in derivatives that it captures maybe money that would have went to actually physical silver. Instead, they're buying these contracts, buffered contracts or one link notes or all this other kind of stuff that would maybe take away from supporting the actual physical silver market.
I agree. Definitely great stuff. I'm still mad at the Mint. And I'm going to stay on them. They got their new annual report coming out in January. And if silver went down in 2001 throughout the year, for the most part, till the end. So they should have a hedge book that is positive. And I can't explain why silver went down in 2021 and they lost 112 million, massively more than they ever have lost in the past. And they should have made money on their hedge book.
Yeah, well, I'll tell you one thing, that people like to blame the banks for price manipulation and the spoofing and all that kind of stuff. But I'll tell you, the industry has done more damage, I think, to individuals' pocketbooks than Wall Street has ever done by these high premiums and there are dealers out there that you're starting to see the tide go out where they were literally taking orders and not even buying metals. I mean, you look at First State Depository and the fraud that they're involved with. That's probably going to be the largest depository loss in U.S. history of precious metals. I mean, you're talking $40 million of metals that are unaccounted for. I think it's over 800,000 silver eagles that are missing in that vault. That's where people really get stung. It's, the price movement. Yes, it's frustrating to watch. But when someone puts $100,000 or life savings into a product and overpays 100% premiums or 50% premiums, they make a 50 or 100% return just to break even, or they don't get their product that they had been promised. That does a lot more damage than any type of person.
I don't see that at all, actually, because we're talking everybody takes the price of the COMEX as the given market value of silver. It's a futures and options exchange. We don't even have a real, I don't call the LBMA a real exchange. It's an association. We don't have a real exchange for silver. That's what we need. A real exchange where people want to buy and sell silver. Get these fucking derivatives out of this world. Right now, you look at how is silver priced? Silver's priced on the COMEX at 300 million ounces traded every day on the COMEX. That's just insane. You look at, there was a single day, I forgot what it was. I think it was probably drive-by shooting, over 2 billion ounces of derivative silver traded in a single day. There's no justification for that in any type of normal, safe monetary system. We're supposed to be the most sound monetary system in the world, with the strongest exchanges, with the best regulators, and it's all bullcrap. JP Morgan and friends get busted for rigging silver for 8 years when everybody was screaming at the CFTC that that's what was being done. And it took the DOJ to go in and say, oh my God, yeah, they're rigging it. We're going to fine them $920 million, the largest fine ever in a commodities history, for rigging the markets. That thousands of people were writing letters to the CFTC and to JP Morgan and the DOJ trying to expose this stuff. This market is more corrupt than any other market, and that's what we need to get rid of, in my opinion.
The spoofing side of it, yeah, it's frustrating to watch. But spoofing and absolute market manipulation are two totally different things. One is the intent to completely defraud and take advantage of. The other one is just simply trying to move the price, however much to profit from the move of that price, to actually profit from a position that maybe you're trying to get out of, or for your client's sake. And that's, I think, the intent and motive to prove that in court on manipulation, I think is obviously a lot tougher than proving just price spoofing, because you can go to data sets that the CFTC is fully, their computer systems and so forth have the capacity to run a lot of these tests and of all this data that they can pull from the banks and trading houses and so forth. But and then they can get into even cross mapping the different types of trades or contracts at the same time to understand where prices being moved in one certain contract out of hundreds of thousands of contracts to generate some type of profit. But to do the manipulation side, obviously that takes a lot more effort, and there has to be a lot clearer intent to prove, or a lot stronger intent to prove that a house was literally trying to move the entire market.
But I think you're making it too complicated. There's emails back and forth from these traders that, okay, I'm gonna pound the market at this point in time, and then they do it. And they had all these emails colluding with other banks as well. Everything data has been saying all along is absolutely true. And they were caught. They just weren't, they settled without really admitting anything. JP Morgan settled, gave them money, they paid off the CFTC without really admitting it, even though they had all the emails between the traders talking about exactly the things that GATA has been accusing them for 20 years. It's gotten to the point where if you're a big enough bank and you have enough lawyer power behind you and enough money to pay off fines like JP Morgan does, then you can get away with this stuff, and they'll catch you once in a while, and they bake it into their cost of doing business. I think that's ridiculous. I think we should get some real regulators in there who are willing to stand up and say, this is just wrong. Because I think we're headed for one of the worst crashes in the U.S. history with this crazy $2.5 quadrillion derivative market that is just teetering. And it's all because of what is being done at the derivatives, companies like Virtu Financial. I mean, I've been following that company for so long, and it's just they're the largest market maker on the COMEX, and nobody even knows who they are other than high frequency traders. They've never taken a delivery of silver in their life. What are they doing in the SLV authorized participants? I mean, there's just so much here, so much problem that we need to get rid of.
Well, Virtue Financial is also the market maker for PSLV, and Virtue Financial is also the sales agent for every time PSLV does an at-the-market offering to bring in more shares to buy more silver. That's who actually sells those shares into the market. So, yet the market makers are definitely the market makers are sort of have a huge impact in the silver market. And I've gone through this with ETFs. If you look at the ETF is structured just like a structured product. It's designed to capture order flow and benefit not only the authorized participants, but it's designed to enhance the profitability of the sponsor, the trustee, as well as obviously the vault custodian. But it's a product within and of itself, and it literally acts as a sponge for the benefit of the authorized participants who are creating and redeeming shares all day long and using arbitrage to basically print money in a way. But that's a totally different ball game.
That would be another discussion, and it would take us forever. We don't have the time today.
Yeah, no, I did the spaces on that, so if people want to look back, I think Tom could post it. But yeah, it is a big problem. That actually creates more price frustration, I think, than just watching the futures market. The futures market actually, oddly enough, is actually pretty transparent. Jim, who works with a clearing firm and this futures broker, can kind of tell you. They'll tell you how many ounces are in the COMEX every single day. But London's market is extremely opaque. You can't really find out any information. The frustrating part with the ETFs is when Morgan Stanley's an authorized participant, they're a market maker, and they just post, however many SLV shares, for example, they have, in their, the quarterly filings and so forth. Those, if they have 100,000 shares, for example, they don't have to describe, 20,000 are market maker authorized participant shares, 16,000 may be clients, 20,000 may be the prop desk or whatever it may be. They don't have to break out any of that information. So it's very, very opaque.
Bix,
Yeah.
I was gonna ask you earlier, you were kind of correlating some of the bank's metal positions and their derivatives positions, and you were talking about this blow up. Do you think it's going to maybe start in their metals positions, or is it because of the derivatives? Like, how do you see that playing out, and is it specifically due to their exposure to the metals, or let's say their short positions in the metals?
I think it'll be part of the same problem, the derivative side. I mean, it's not just silver that you have massive rehypothecation of assets. You get that in U.S. Treasuries. You get that in all kinds of derivatives these days. So I think because silver has been so controlled for so long, there's more players that could be affected, but it's going to be throughout everything. I mean, if you look at 2008, I think 2008 was kind of a precursor of what we're headed for. The BIS just came out and said there's 80 trillion in FX derivatives that they can't account for. I mean, it's gotten so incredibly out of hand that I don't think the silver market's going to survive this. I don't think the COMEX will survive another collapse like 2008. And remember, 2008, Congress almost voted not to bail out the banks. I don't think any banks are going to get bailed out this time, but I don't think the politics is going to allow that. I would love a freely traded silver market. I don't mind derivatives as long as they're legitimate derivatives. When people are throwing around billions of ounces with the click of a mouse, that's a problem.
And so for those that don't necessarily know, Bix, can you give us a bit of a refresher on what happened to the COMEX in 08?
Well, if you believe people like Ted Butler, and Bear Stearns was the problem. They had a massive silver derivative position. That's why JP Morgan had to come in and take over Bear Stearns. And that's when Bart Chilton, the CFTC commissioner, said, hey, we have JP Morgan. They're way offsides on their derivative position. They've exceeded the time limit to get rid of this derivative position. And he went to Gary Gensler, who was the head of the CFTC at the time. And Gary Gensler said, we're going to make a political decision to not stop them doing what they're doing. Things like that. And all it does is suppress the price of silver over and over and over again. To me, I have no idea what the price of silver should be right now. But I know what the price of the gold silver ratio should probably be closer to what reality is, 8-1. Maybe historical 12 to 15-1, but not 80-1, 90-1. I think it's down to 75-1. That's just ridiculous. There's nothing in the silver world that you can point to that says gold and silver should have a 75-1 ratio. Nothing except price.
Interestingly, since the 80s, silver is the only commodity or metal that is cheaper now, not even adjusted for inflation than it was then, right?
Less than 50%.
I guess if you're taking, all-time highs, but still.
Tom, there's a few other futures too, a few other commodities. It's not just silver. There's a few other ones that are less than they were in 1980.
Like what, Jim?
Natural gas, Tom. Natural gas hit $14 in I think in the late 80s or the early 90s, and natural gas was under $6.
That was before the fracking changed it.
I was going to say we can probably point to a lot of good, supply side technologies that have helped bring that down, right?
Well, it was $10 this last summer, and it's half of that now. So there's something going on. I'm not quite sure. I don't get it. The other competing fuel, the heating oil, was up big today, and natural gas is it's under $6. I don't think it should be under $6. But I just wanted to, if you don't mind, the word is correct you a little bit that there's more than one, more than silver. There's a few other futures possibly that are under their 1980 highs.
Well, I appreciate that correction, Jim. Bix, was there anything else that you wanted to hit on towards David's point, or in your world, how you see the manipulation that you think that most people don't understand? Anything like that?
Well, to me, I would just like to get straight answers from the CFTC, from the U.S. Mint. And for people to, when the JP Morgan takedown happened and they took JP Morgan out of at least trading on their house account a couple of years ago, and the $920 million fine, I thought, yeah, that's great. Hey, we're getting there. We're getting somewhere. And then Rustin Benham comes up in the silver squeeze time frame and says, hey, we were able to tamp down the price of silver. And what does that tell you when the regulator says, oh, silver almost hit $30. Oh my God, we better tamp down the price.
Bix, he didn't say tamp down the price. He says we tamped down some issues, but he did not say he tamped down the price. He shouldn't have made the statement at all, but he didn't say we controlled the price. That's not fair.
He said the structure of the silver market was we can go back and listen to it, but he did say tamp down.
He did say tamp down, but he didn't say anything alluding to controlling the price. He didn't say, luckily, we were able to tamp down the price. He did not say that.
Correct. He would not have the ability to do that without talking to his people, or at least the banks or whoever he was working with. The two people that came out and said this is a huge problem, or said don't worry about this is nothing, was Jeffrey Christian and the guy from Goldman Sachs. Who said all the shorts were the...
Jeff Curry?
Yeah, Jeff Curry, who said all the shorts were the ETF participants. And I'm like, wait a minute. If the silver on SLV is being shorted by these banks, SLV is the trust is the owner of that silver. There's no reason for these authorized participants to be shorting silver deposited in the trust and held by the trust for the shareholders.
It's also come out, Bix, that statement was made in error, that SLV they are not hedging their positions.
I didn't think they would. I mean, was it BlackRock owns it? I can't see BlackRock allowing anything like that happen.
Tom, could we ask about maybe Bob's and Bix's and, what people think for the outlook for 2023? That's part of your title up there. Is that okay?
Yeah, absolutely. I just kind of want to make sure that we're kind of dealing with one specific thing at a time here, Jim. Kind of wrap one thing up at a time. I was just going to ask Bix, when JP Morgan was the spoofing thing was brought into court, wasn't it just difficult for them to prove, let's say, intent? And wasn't that kind of the wording that they talked about around why wasn't a more serious charge, let's say?
Well, I tend to agree with Ted Butler. They had to get him for something. They were going in there. They had him for conspiracy. They had all the emails of the traders trading back and forth saying, okay, we're going to hit it at this point in time. They had everything. The question is, because they are so big, because they are so gigantic, what could they admit to but not be sued on the civil side? And that would be spoofing, because theoretically spoofing doesn't affect the price directly by placing a bid. You see what I'm saying? The full transaction wasn't made. If you're spoofing, you're constantly pulling them back just to
right,
push.
because it's over
Right.
a short period of time, isn't it?
And that was Ted's take on why JP Morgan admitted to doing that. They can get him for a ton of other stuff if they go through their emails, and which they did. But I don't think that whole situation is over either. They're on a deferred prosecution, and about a year after that started, it's a 3-year prosecution, I think. They got caught again, this time not disclosing communication through WhatsApp, and had to pay another $100 million fine. And it's like, didn't they just break their deferred prosecution? I don't know what's going to go on with that. I think it's such a bigger thing with everything else involved with the derivative world kind of going sideways. It's kind of crazy out there. And the more you learn, the more you want to go back to just free markets. I think if we go to free markets where you'd have to have a reason to go place $1 billion or billion ounce dump on the market type of thing. And I think more transparency, as in who has what and who's trading what. If they're going to move the market, everybody should know about it. Things like that. I made a 19-point thing and gave it to the CFTC about 10 years ago. And Bart Chilton brought it up in one of the things, and Gary Gensler laughed it out and said, no, we could never do that. We'll see what happens come the end of this year and moving into next year. But everything looks very fragile to me.
Yeah, it seems like with take the Japan's issue raising interest rates by 0.25%, and the effect that had on the market the other day, the volatility that created in the FX and the metals markets. It's interesting to see those little symptoms and then the effect that they end up having over that day. And as you say, it makes you think that the system is very fragile at this point. And when little things like that happen, the outsized effects that they have, it's probably only a matter of time until we get something bigger and wake up one day and have all of a sudden everything's completely different, right?
Yep.
I'd like to agree with what Bix is saying, and Bob touched on it earlier in the meeting tonight, and Ted Butler has talked about it several times, that the spoofing shouldn't be taken too lightly. It was, as Bix says, it's what they were probably the most easily able to get them on and get fines paid on those, I think it was 4 or 6 traders. And it's basically it's a price capping or a price getting maneuver to move something to where your orders are, where your customers' orders are, or to prevent the price from getting to where an adverse price movement against you. So I agree with Bix. I think this spoofing deal was a bigger deal than the people in the trade or in the public. And the public may not quite understand it so much, but I thought it was pretty telling that they got him on spoofing.
You have to understand too that the spoofing was also, it wasn't just to the downside, it was to the upside too. They actually manipulated prices higher.
Yep. They have been. I mean, they run it down, they run it up, they run it down, they run it up.
The other thing, if people in the room understand, the leverage involved, if some of these big banks, if they're trading 100 or 200 or 300 contracts, a 50-cent move is a pretty big deal. 50 cents is $2,500 on a silver contract. if you've got 100 or 200 or 300 of those, and your spoofing order is getting you filled, either getting in or getting out. To me, it's a pseudo manipulation. I didn't like it.
One thing I was going to mention too, one of the reasons why you see like the WhatsApp situation, private communications, the lack of record keeping and reporting, is it's easier for the CFTC to actually hit clearing members or participants, registered participants, for those types of violations because they're clear-cut violations. It's an open and shut type matter versus having to actually go to the attorney side if they're willing to want to take a case, try that case in a court of law, and go through the money that's and resources that they would tie up to actually bring a case to trial. There's obviously a lot of risk on the government side to do that, because if they don't feel like they have a strong enough case, you zap a lot of resources that would otherwise. You got to remember, the precious metal markets are just one small fathom of everything that the CFTC looks at. So when they run data sets and so forth, I mean, they're looking at the equity markets, Forex, interest rates. I mean, those markets are enormously bigger than the precious metals markets. So they're focusing on a lot of different things at the same time. And not only that, in the precious metals markets, like any other market, they have to have somebody come forward in the industry that maybe, through whistleblower or something that could give them some type of insight on what to look for. There's a lot of data out there that is just simply overwhelming. That, if you don't know what you're looking for, it's like looking for a needle in a haystack until you come across something. Even though we may see, hey, listen, the price went down on a Sunday night, $2 an ounce on silver, which made no sense to have it in the most illiquid time of the day, and someone sells $2 billion worth of futures contracts. But they can pull some of the data set from that. But to try to figure out how that was manipulative, they'd have to run all the contracts associated with silver, not just in the the Globex, but possibly other types of markets as well, to see and try to figure out if any players were in those subsets of markets that were actually had positions that they were liquidating. And then they have to go back and look at the records of where they bought them at. I mean, there's a lot of stuff you have to kind of turn over to figure out market manipulation versus, a regulatory type of oversight.
I think that's why the best tool they have is whistleblowers. I mean, for the JP Morgan thing, they couldn't have done it without that whistleblower. They paid him $120 million for a whistleblower fee. And just looking at the latest thing with FTX, they had a whistleblower there. They just paid the guy $20 million. That's what the CFTC really needs. If they don't want to get into these big, long, drawn-out things that the big banks can always get away from, just get whistleblowers. And people are ready to turn on their boss in a second if they think they're going to get in trouble. I applaud the CFTC for building that program out, and kind of pisses me off that a JP Morgan employee got $120 million for telling on JP Morgan when Ted Butler's been doing it for, 20 years, 40 years, however long he's been doing it. But at the same time, it wouldn't have happened unless you have someone on the inside who was part of it, ready to flip. So, yeah, we're going to see a lot more, I think, in the future of the whistleblower stuff.
In support of what Bob was saying, too, I'd like to just ask Bix if he agrees. Bob, I believe that they had correspondence between trading desks. And to me, I believe that means collusion. And if they can prove collusion, I believe that's where the RICO articles can be done. Bix, do you agree with that? Did they have communications between trade desks? I believe they had that evidence. Is that true?
Yeah, they did. And each side was admitted guilt, too. So they could have got them on RICO. And in RICO charges, the penalties are 3 times what you stole. So if you look at what JP Morgan's stolen over the last years, and it was also U.S. Treasuries, they could have put JP Morgan out of business instantly. But again, it would take, they have so many lawyers at JP Morgan, they have so much money, and the CFTC especially, and the SEC, seem to go after people who aren't well funded, and even if their case is kind of weak, they'll go after them as the big bully on the block, and we've seen that in cryptos all the time too. So it's a regulatory problem we have that I wish we had better regulators.
And that kind of goes towards your point, Bix, about having a little bit of a simpler and more of a free market rather than these complicated derivative setups that the CFTC really, kind of to Bob's point, they're don't have the ability to really keep an eye on all of this.
I would say it's close to impossible to track down all the derivative moves that and keep an eye on it. I mean, there's so many places you can hide things with a derivative. It's unbelievable.
I was going to say, it's one of the reasons why I try to promote physical metals as an investment versus the ETFs and structured products and structured vehicles and unallocated programs and all that kind of garbage, because the issue you run into is ultimately in a deleveraging environment, which we're in, you're seeing a reduction of physical supply out there. Is ultimately someone's going to be left holding the bag, whether they're short the market or they need metal for making product, whatever it may be. It's going to create an upside an upside leveraging event or deleveraging event, like we saw in 2011, where if you're hedged the market and your hedges are blowing up and you got to cover, you have to pay whatever price you need. In this world, if the dollar starts going down like it is, it's the dollar going down, not necessarily real rates, that are going to drive people to the metals. And the one thing that a lot of people that may not understand is what's moving the metals is not necessarily interest rates and inflation. It's uncertainty and also political uncertainty as well. We're safety and that type of thing. And with the crypto blow up that we've seen, that adds to the flare of the metals is that, hey, it's been around a lot longer than everything else has, and it's going to retain value. And it's been attracting this underlying bid in the market, and slowly it's really been disguised really well. And the retail community has been caught flat-footed here because of the big shakeout we had over the summer and into September, October. A lot of people have basically started to become sellers or just walking away from the market. And some of that could be due to premiums, but I think some of it's due to volatility. Some of it's due to, hey, listen, I need capital because my equity and bond positions have gone into the toilet. So I got to hold on to that stuff because it pays an interest. So now gold has become a funding vehicle. And that's one of the reasons why I think the ETFs have seen a reduction in asset flow, because I think they become an event where going into year end, they're trying to clean the books up. And I think they're using the metals because it's not down as much as the other portions of their portfolio. They can use that as a cash portion or cash raising mechanism. I mean, you saw it obviously with the REITs, the privately traded Starwood and Blackstone REITs that basically canceled or stopped redeeming or providing redemptions out of the funds. People are going to go wherever they can get liquidity, and that's been the metals. But you've had this underlying tone of, I think that's it. It is. I think that's the essence of a bull market. Is the bull market tends to go up when nobody trusts it, and I think you're seeing that in the metals today. It's a perfect setup.
Bob, maybe we could go over just the idea of what you were mentioning earlier about the premiums kind of collapsing over the last week here or so. You had mentioned you had really seen the premiums come down quite a bit. So where are you seeing that, and what do you think the cause of that is?
It's happening across the board. I mean, you're seeing more so in the 1 ounce product, silver especially. Gold has been coming. I mean, you're looking at, we have on our website, we have a pricing page for precious metals. You can kind of get an idea of what we offer products for. I don't have very much markup compared to the wholesalers out there. So you can get a real gauge of what wholesalers are doing just by watching my page. What we do is a little bit differently because we go to the wholesalers when we need product. We don't actually carry inventory, so we don't have to hedge and have extra carrying costs. So we don't have to mark up things a lot. It's a win-win situation that I've been doing this for almost 15 years. It's worked out really well because it really provides the emphasis on the client's needs, not necessarily me acting as a dealer, so to speak, and trying to sell the product of the day. But what's happening in the marketplace, like for instance, Gold Eagles, which were, a month ago, on the wholesale side, they were as much as 11% over spot to buy them from a wholesaler. They're down. I mark up about 1%. So they're about 4%, 4.25% over spot, maybe 3.75%, something like that. I'm selling them for 5% over spot. But they've been coming down from that 11, 12% over spot. So they've gotten cut in half. I mean, you look at Silver Eagles, for example, I'm offering those at $9.50 over spot. Those are at the wholesale level. About a month ago, they were $14 over spot, $12 to $14, something of that nature. The bids, if you look at the bid side, they've just, they were $12. Some of the wholesalers were bidding $12 over spot. Now they're bidding maybe $5, $4 over spot. You look at the junk coin market, they were offer side was $10. The bid side was maybe $8. Now I'm selling junk silver at 3.25 over spot. The bids are maybe at the wholesale level, maybe 50 cents over spot. I mean, it's just completely crashed. And it did it for the exact reason I said it was going to happen back in November, was that as you're getting into the end of the year, you're going to have the 2023 crossover years starting to come to market. And so what happens is you have a bunch of metal that's going to be coming to market that's been made from September, October, November, and they hold it, till December or January to start selling and start delivering it either December or like the U.S. Mint side, they start delivering in January. Well, you just didn't have that product available in September and October when these premiums hit their peaks, and you had a crossover production years at the same time. So you had this perfect storm sort of swirling around, raising the premiums. And then, of course, you had this frenzy, like Zero Hedge put out an article, when APMEX went to, they made this public announcement that they were buying Silver Eagles back at $10 over spot, charging $18 over spot for the coin, which was sort of a joke. And then, of course, they had a lot of these retail dealers in that same article basically just throwing gasoline on a fire, trying to create a frenzy almost. I was like, this is it. You can't get much more of a frenzy than this. And so when that article came out, that actually is when everything pretty much peaked within about a week and then started to subside.
I do remember you kind of calling the top at that point, because we talked about that on another space. Yeah.
Yes, and it's just a shame because I'm seeing people that have bought Silver Eagles that call me and say, I bought these things at $15, $16, $17, $18 over spot. And I said, do you realize once silver goes to 35, and it eventually will, you're going to see a lot of people starting to sell because, like Bix had mentioned, they made a lot more Silver Eagles back in 2010, 11, 12, 13 than they did in 2020, 21, and 22. So there's a lot of overhead supply that's eventually going to come back onto the market. There's nothing special about a Silver Eagle. It's a bullion product. It's not like it's laced with gold lacing or trim or something like that. It's just right now you happen to have a situation which you saw the exact same thing happen in 2008 and 2009 when you had the big financial crash, and then all of a sudden people were flocking to physical metal because it was like watching the system in slow motion collapse. So you had back then in 2008 and 9. Instead of waiting a month for delivery or something like that, it was 3 months for delivery. You had to wait 12 to 16 weeks after paying your dealer for the until you got any silver product. It wasn't just Eagles; it was rounds, it was 100-ounce bars, it was anything. And so, but that ultimately kind of cured itself because what happened was the wholesalers would raise the bids to attract more metal to come back to them so they could sell it. And so eventually you got that equalizing effect. Well, what happened the last couple of years, the reason why the premiums have been really high, 2020, 21, 22, is this was due to, you can thank Donald Trump for this, and the 2017 legislature is when they passed the 2017 Tax Act, Reduction Act, they took out the ability to do 1031 exchanges for precious metals. So no longer could you swap silver for silver or gold for gold and roll your cost basis forward into the new product. They disallowed that. So what would have normally happened for guys like me that saw $10, $12 bids for Silver Eagles and would say, hey, listen, this is great. I'm going to go ahead and just sell these Eagles and buy 1,000-ounce bars and capture a hell of a lot more ounces. Well, now you had the problem the last couple of years was you had to pay taxes on your gains. So you didn't have this arbitrage purely based on the premium arbitrage. You had to take into account any type of tax holding costs that would then pop up. So it kind of thwarted the idea of simply saying, hey, listen, I'm gonna swap products, because you did have to take into account the tax ramifications. that partly what hurt the industry's ability to compensate and be able to sort of equalize premiums and product shortages or tightness, whatever you want to call it. And at the same time, you had the industry jump on these adjectives or these verbs, whatever you want to call them, in terms of using shortages and other types of inflammatory types of words to get the public really revved up into buying high premium product. You saw it in 2021, right after the silver squeeze movement. There was guys that ran a big fund, well known in the precious metals community, come out and say you couldn't get 1,000-ounce bars for up to 3 months out or something like that. I was getting 1,000-ounce bars and having them delivered within 3 weeks. I mean, in huge, sizable quantities. It wasn't just a one-off type, hey, I'm buying 1,000-ounce bar. It created this frenzy. And then you saw this frenzy die down in May of 2021 when the mint was getting ready to come to market with their Type 2 Silver Eagles, when they changed the face on the coin.
Real quick, I got to run, unfortunately.
Oh.
But thank you so much for having me on. It was great fun.
Thanks
Sure,
very
thank
much
you,
for
Bix.
joining us, Bix.
All right. Talk to you later.
And so when June came around, you had the new product come out into the market. The prior 2 months, the mint hadn't delivered any new product to the market. So when they brought new product to the market, the premiums got cracked pretty hard to the downside in June and July of 2021. So you see this sort of pattern kind of come into the market. And part of my job is, and it's sort of, the dealer model has a huge conflict with this type of recognition of doing what's right for the client and looking at their best interests. Their job is to move product. And I totally get it. It's their business model. I mean, it's what they do. They have to make money. I totally get it. What I try to do is look at this thing from sort of a advisory type of role of, hey, listen, what's the best product for the best premium at the moment? Not necessarily what's the best product, period. And that's where you tend to save clients a lot of money and avoid these sort of pitfalls of paying extremely high premiums, because there's going to be people, unfortunately, that probably paid 100% markups on product that it's going to take 100% move in the metals just to break even. And I hate to see that, because a lot of these people are putting their hard-earned money into a product thinking they're going to protect their purchasing power, but all they did was just move the purchasing power to the dealer's pocket or to the industry's pocket. And that's unfortunate.
Yeah, absolutely, Bob. Kind of going back to what I was talking about earlier about how the market's reaction to Japan on Monday moving their 10-year interest rate. How do you see moves like that? Am I missing something when it comes to why that had such an effect on the market?
Well, it's all about the dollar. If you look at the reason why the dollar had gone vertical to the upside was the idea that Japan's doing yield curve control and it's just going to print as much money as they need to basically cap the yield, and them coming out and saying, hey, listen, we're going to allow for a higher yield. All of a sudden, you had a lot of people betting against that whole idea. And you're dealing with holiday season with illiquid markets, not as much trading volume, and anything can have a magnified movement. But I think it's this idea, if you look at the dollar, I think the dollar peaked in September of this year, and you certainly had a hell of a frenzy around the strong dollar policy and so forth. And you could see it starting to squeeze foreign countries and especially the Eurozone and that type of thing. It was having a huge impact, and it was starting to have a huge impact on money flows. And who can afford a U.S. Treasury if it's just like a premium on a gold eagle or silver eagle? If the dollar becomes too strong, it makes the U.S. Treasury that much more expensive to purchase, and the volatility or the risk of volatility that much greater. So, if someone's buying dollars, say India and Brazil are doing trading together and they have to accumulate dollars, and the dollar is that much more expensive, somehow they have to hedge their bet, I guess, or their reserves, so they don't lose profit, or the company doesn't lose profitability when they're trading in dollars, and then eventually take those dollars and convert it into a local currency. And that's one of the reasons why I think you started to see more countries starting to trade with each other in their own local currencies, because the potential for volatility was just getting greater and greater. If the Fed wants to reduce the amount of dollars in the system, that's going to be restrictive. it's going to be very hard for countries to do trade with less and less dollars out there as financial assets are going down in value and you're not seeing the trade flows. It's harder to accumulate those dollars, and that'll be restrictive in terms of economic activity. So this is why I think the dollar, the gold and silver story now really has nothing to do with inflation, because inflation's peaked and we're in this sort of cyclical move now downward with inflation, because you're going to have also higher inflationary comparables, month over month comparables as well. But you see, obviously, oil going from 130 to where it is now. It doesn't take a rock science to figure out there is some deflationary trends that are in place right now. The issue is now the economy. You're going into next year, are things slowing down faster than what maybe the market realizes? And you're seeing the effects of all these big jumps in interest rates, lag period, that 6 to 12 month lag period when they raise rates 75 basis points. You have to wait till the tide starts to go out again to see what the effects are. Well, that's you're going to start to see that here in the first quarter. And I think you're going to see some volatility really start coming into the markets, I think, in the second quarter of this year. And that'll be positive for the metals, because the idea with the metals is they're going to look forward with the idea that at some point the Fed is going to have to be supportive, because if we see any type of impact on the economy, it's going to impact tax receipts. And if it impacts tax receipts, the U.S. government's going to have to come to market with more debt. Who's going to buy all the debt? I mean, that's something I've been saying for quite a long time. And it's that ability for the market to absorb all those treasuries. If the Fed isn't willing to do it, that's ultimately going to have a depressive effect on the general markets. Even if the economy is somewhat going sideways, it's this crowding out effect that the U.S. Treasury market could ultimately have. Now, if you look at what's happened in the last 3 weeks or so, you've had $100 billion in pay downs with the U.S. Treasury, and that's what's kind of lifted the financial markets up a little bit, because everyone was actually thinking that the U.S. Treasury was actually going to be coming to market with more debt. But Yellen ended up surprising everyone and started paying down T-bills. That's going to come to an end of this upcoming quarter, because I think it's up $500 billion. That is what the TBAC is expecting to have the Treasury come to market with more debt. So it's going to have an impact, I think, on financial assets going into the first quarter.
Yeah, that absolutely makes sense. And that's something that I've been trying to get everybody's take on is how long these rate hikes are going to take to actually move through the economy and cause the damage that they are going to. You know, when companies have to refinance the debt that they have on their balance sheets, that's going to start cutting into their quarterly reports. And I think we have yet to see a good amount of that really come into the market and affect it.
Yeah, like for example, I mean, I run a hedge fund. So as a fund manager and looking at the markets for the last 30 years, I've been doing this. You have to have some degree of flexibility and belief in what your conviction is. I think, like for example, I think if the markets kind of stop today, for example, I'm net positive up on the year, and I don't do very much trading in the fund. I mean, fund is 99% physical metal. I mean, it's a very simplistic idea in the way the funds run, but I don't want to overtrade. The problem I think you have in the general markets is a lot of people overtrade and overthink. It's almost like it's the idea of paralysis by analysis, I guess is the saying. If you watch the day-to-day activities, my God, you can get whipped up into a frenzy and get just churned and burned right out of the market. I think that's what's happening with a lot of players on FinTwit and just in the markets in general, is a lot of people they got caught up in a lot of these meme stocks or momentum stocks, or whether it be a commodity trade or some sort of fixed income trade. You have to give yourself the ability to breathe a little bit and to say, okay, instead of looking at the next week as a long-term investment, you got to look at the metals as a cyclical or more of a secular play on where we're headed over the next few years. And I think that's the advantage of owning physical metal, because not only is it harder just to hit the sell button because you actually have to move this stuff, but it forces you to say, well, what was the reason I bought it for 6 months ago or whenever I bought it? And has anything really changed? And I think that's the advantage that gold and silver provide physical owners is that they don't get shook out of the position as much, because in reality, not much has changed. All they try to do is just kick the can down the road to make the market or the treasury market seem more appealable, so that the treasury can sell more U.S. treasuries. But in reality, the only thing that's changing is more and more debt that's actually in the marketplace, or that's going to have to come to the marketplace. And ultimately, that's going to have to, the Fed is going to have to step in at some point if the Treasury starts crowding out, and that's going to have a negative impact on the dollar. And there's going to be reasons, we don't know them yet, but there's going to be reasons why the Fed's going to have to come back in or have to maybe start lowering rates. And lowering rates isn't just isn't some symbolic gesture. Lowering rates requires adding money into the system. And it's really the market that's lowering those rates. It's not really the Fed. The Fed's just basically chasing the market. That's why you have to really look sort of underneath the hood a little bit, rather than just the headline stuff.
We've had a couple questions come in about your outlook for 2023. So if we could kind of give us your thoughts towards what you're looking forward to for next year.
Yeah, I'm kind of in the camp that I think you see some volatility in the first quarter of this year coming up. You'll see some choppiness. I think the metals will be, the metals may get caught up a little bit in the volatility, but I think overall, I think you saw the washout lows. I think you've seen structurally, you look at the bank OCC reports, for example, the derivatives reports that just came out, and I posted a link to posted this yesterday. Goldman Sachs going from 18 billion to 1.5 billion or 1.7 billion dollars in derivatives in the precious metals category. And you have to understand that in the third quarter, you saw a lot of unwind. Some of these derivative securities, you saw a lot of pushing out of forward contracts, so that created a lot less option and forward contract activity that would be considered derivatives, maybe that may be placed on these reports. And so you had a lot of that washout occur. And I think of course, that goes with the backwardation story that we saw as well, that a lot of the selling and so forth was all paper generated. It wasn't physical. And of course, then you had what India and some other countries were doing in terms of the physical product. As prices were coming down, they were taking advantage of that. So all that kind of tells us that, I would imagine India's activities probably subsided quite a bit, because most of their buying came in under $22 an ounce. Above 22, they may be on the sidelines. But the dollar coming down, I think, is what has caught a lot of people by surprise. But I think you've seen a lot of unwind of hedges, and that's forced the price up as well. So you've seen ETF flows actually negative outflows of money going out of GLD and SLV. But I think what's forced the market higher is these unwind of short positions and some of these hedges as well.
So to kind of sum it up, some volatility, but seeing some movement in a lot of these positions that the banks are holding, right?
Yeah, you got to remember too, the Basel III thing goes into full force, I think, in London. It's already been accounted for, and that's could have been also some of this unwind in derivative activity as well. Supposedly, with Basel, a lot of this derivative activity is supposed to be put on the clearing exchanges, but in reality, if you look at these reports, like 80 to 90% of the derivatives being held are actually held over OTC. So it kind of goes counter to what Basel III was intended for. But then again, if you look at the derivatives, they're really securities, are not actually on the balance sheet of the bank. They're sold as a security, but they may be backed by, as a counterparty, the bank or the bank trading desk's activity or a subsidiary of the bank. What I tend to look for is the longer term story, that 2024, as this recession starts to unfold, because it's hiding itself very well. The labor market, which has always been a lagging indicator, is usually the last thing to roll over. And you're starting to see all these second tier effects of rate hikes with regard to repossessions of cars. And you see the mortgage industry laying off a lot of people, and you see the real estate market and real estate agents, you see the slowdown that's happening in the real estate market. All these things are typical second tier effects that take time to roll over. And I think it's going to kind of come to a head in the first maybe beginning of second quarter of this year, with this recognition that, oh my God, things are a lot slower than we thought. And you're going to see cost cutting and all, and that earnings sort of story where, stocks will have to maybe readjust because the earnings aren't going to be there. But eventually that's going to have to pull the Fed back into the picture a little bit. Again, that's why the metals are moving the way they are. The dollar's been moving the way it is this recognition that the dollar is actually probably following the economic picture more so than anything else at the moment. I mean, the Fed hasn't stopped raising rates, yet the dollar has already gotten creamed a little bit here. So there's obviously something else that the dollar's watching.
Yeah, absolutely. And it was interesting to see the dollar move down along with the yen, as the yen makes up a good portion of the DXY. So that was kind of interesting to watch too. Anybody has any questions and they want to jump in here, we can take some questions. Other than that, Bob, is there anything else that you wanted to talk about this evening?
Well, I think going into next year, you want to be, if you're a physical metals owner, you store your metals in a structured program or something of that nature. Be careful and read the contracts that you signed, that you agreed to, because a lot of information is hidden in those contracts. I mean, it's the bare bones responsibility and liabilities that's being communicated to you in those agreements. This thing with First State Depository, I know we had someone ask earlier today, if you could go over that a little bit of what to look out for and what to understand. It's one of the reasons why I opened my own depository back in 2008, because I don't trust a lot of these firms. I mean, most of the depositories out there are either owned by a gold dealer, they're owned by a financial institution, or they're owned by a cash and transit company like a Brinks. So they're all designed to be transaction revenue oriented models, which I did not want to get involved with, because like we saw in 2018 and 19, when the market started to get really quiet, a lot of dealers were losing money during that 2-year time frame. And when you're storing metals has nothing to do with the parent companies, most of their transaction model or revenue model. The storing metals is a very minute part of the business. It's a small margin business. It's not designed to be the cash flow. So understanding that, I didn't want to have a situation where, as an advisor, I'm storing metals at a facility that could be economically impacted because of a downturn in the market, which is the whole reason why you own the metals to begin with in the first place. But almost the way you bought the metals and placed your position with a third party could actually put your portfolio more in danger than just simply owning the stock market, because it's the idea that, First State Depository was $138 million. It was recorded in their inventory system. They can't account for $40 million of that. I mean, that's a huge loss. I mean, it's going to be the largest, like I said earlier, largest loss in depository history probably. And it was fraud. I mean, the CFTC has filed fraud charges against the owners of Argent and as well as First State Depository, I believe. It's a mess. I mean, yes, you had 20 some odd $1 million with Northwest Territorial Mint, where they were basically taking metals out of people's boxes. And I think it was even, they were writing the date and an IOU next to it when they were taking the metals out, or how many coins they were taking out, thinking that they would pay it back. But again, the agreements will say a lot of this stuff. It'll actually explain a lot of this. These pooled programs, these unallocated programs like Perth Mint and so forth, it was no surprise to me when everyone was making a big stink about these pooled programs. I was telling this back to people back in 2010 of how sort of dangerous these programs are and how they're used as a balance sheet financing operation. They're not actual metal. You look at a lot of these digital programs today, you have to read these agreements, because if the agreements are very one-sided and have these massive limits of liability clauses in there, there's a reason why they put these limits of liability clauses in there, because there is a lot of risk that you could lose everything. And the attorneys for these companies and these sponsors that create these agreements are going to limit the risk to their client. That's a red flag. I mean, these are simple things that you can look at, if that kind of helps.
Yeah, absolutely. Street Hawk, you wanted to ask a little bit of a question about silver's trajectory this year?
Yes, I'm outside. I hope that my voice is coming through. in some circles, there's a bit of a frenzy that, gold could go to 3,000 sometime in 2023 and silver to 50 or 60 because of, the economic backdrop and interest rate, dollar activity and inflation, volatility, all the things that you've been talking about. Do you think it's possible? Is that something you're seeing as well?
Ultimately, I think silver could get to 65 pretty easily. It would take an event. I think it would take maybe later in the decade, possibly after 2024. The election in 2024 is going to be very divisive. It's going to be very polarizing, and I think that's where a lot of this dissension and frustration is going to kick in the gear. And I think that's what's going to move the metals higher during that time frame, and that's when I think you may see the big run. But I think you could see 65 on silver, and then you have some type of back off. That could easily happen, only because the market right now is just resetting itself on the physical side. Prices got so low, and it created so much buying activity that obviously the premiums got way too overblown. But I think people are becoming even smarter this time around of where to buy the metal the next time around. Like 1,000-ounce bars. You could buy 1,000-ounce bars, or dollar over spot or whatever it may be. You don't have to buy silver Britannia or at $7 over spot, or 100-ounce bars at $5.50 or whatever. Some of these premiums were just crazy. You can go to smaller product, and what's happening is people are starting to realize, especially with the silver market. I mean, you're talking $700 million or $800 million would wipe out all the metal in the registered category. Yes, more metal could come onto the registered category, but that would have a massive impact on price. It would have a massive impact on hedging. Anyone who's short the contracts would be forced to cover. I mean, that's the kind of stuff like the nickel market. You start to see a price spike start to develop. And that's, I think, what ultimately could easily happen in the silver market, because people are starting to realize, well, wait a second, I don't need to buy retail product. I can just buy a 1,000-ounce bar, and I have actual representation and ownership, and nobody can take that away from me. And at the same time, I can take delivery of this stuff. It hasn't been contemplated very much in the past. Yes, you had the Warren Buffett take a bunch of 1,000-ounce bars and that type of thing, but that was in a very structured manner. I mean, this is something where you have a real risk of a dollar contagion to the downside, as well as this idea that 30 some odd $30 trillion in U.S. Treasury debt, and umpteen trillions of dollars in consumer debt and private corporate debt and municipal debt and pensions and all. I mean, you just had, what was it, last week or 2 weeks ago, you had the Teamsters Union $36 billion pension bailout by the U.S. government, the largest private pension bailout in history. I mean, this is a slow motion train wreck that's only going to get worse over time, especially if interest rates stay up where they're at. It's going to accelerate the move, because it's going to increase the interest costs and the cost of maintaining debt and so forth. And so, again, that's why you're not going to see it. Literally, you can't see interest rates go up very, very much more from just a national security perspective. But that all, again, that's why we own physical metal, because we're all playing the long game. We don't want to get shaken out. We don't want to be on leverage. I mean, that's why I tell people, don't buy silver on leverage. I mean, yeah, if you want to play options and gamble, that's one thing. But for their core position, you get enough leverage just buying the physical metal. I mean, this thing can really move.
Great. Thank you.
Matt, you had your hand up. Did you have a question?
Hey, yeah, thanks very much. I do have a quick question. I'm a media reporter in Canada, and I work in a commodity province. So I thought, I'd jump into space. I do have a question, and you've touched on it a couple of times regarding interest rates and inflation. And I do want to ask you about that. And I'm just going to read off about 25 seconds of data here, and then I'm going to ask about your thoughts on inflation. I'm looking at a number of inflation related data, and there's so much of it out there that you could drown in it. But here's a couple of major points. I look at some varying forecasts for the price of oil, and there are a number of them that suggest the price of oil could go up, certainly as China begins to reopen more and more, and we'll see how that goes. I'm looking at inflation in other countries: Germany 10%, UK 10.7%, Sweden 11.5%, Italy 11.8%, Russia at 12%. That's over in Europe. And Japan made a move that a lot of people suggests outlines potential concern in that country about inflation. Canada's CPI came out today, and inflation was barely down from 6.9 to 6.8%, but a lot of core prices still went up. The question that I have in the context of that data, which a number of people would say would put upward pressure on inflation and then perhaps more pressure on interest rate hikes. I'd like to know what your outlook for 2023 and 2024 is on inflation and interest rate hikes, because you have said, and I'm not saying you're wrong, that you're not suggesting or predicting that interest rates will go up much further, but there is some data out there that might suggest otherwise. So I'd like your thoughts on that, if you could provide that, and then sort of its relation to metals prices like silver.
Yeah, I think interest rates are going to go up again. I think interest rates aren't really a function of inflation as much as they are about the plumbing of the system, meaning if the treasury market has to sell more treasuries and they sell more treasuries than the market can bear, and the Fed isn't willing to buy them, interest rates are going up, irregardless of whether inflation is high or low or indifferent. That's the way I kind of look at it. It removes a little bit of the visors, the blinding visors that we get caught up with inflation. Because you got to remember too, inflation, the CPI numbers are, like probably most countries, they're heavily manipulated with regard to hedonic measurements and so forth. You look at like in the US, you have owner's equivalent rent as the main portion of real estate, the real estate portion of inflation. And owner's equivalent rent, real estate prices have been coming down, but owner's equivalent rent has still been going up. It has a built-in lag effect to it. Inflation actually is rising in that department, even though real estate prices are coming down. I mean, I'm not sure how Germany and all those guys measure all, have their minute measurements and statistical measurements of different portions of inflation. I look at it just from a standpoint of government's need because the government now has become such a behemoth in the markets and governments around the world for that matter. I mean, they needed negative yielding rates, pull off this big scam because of the COVID thing. Well, they needed to do that just to drive growth. Well, what are they going to do next time around if they have to drive some type of growth because tax revenue receipts are falling? So interest rates can only go up so much before, I think ultimately the currencies are there. It's not that interest rates are going to go down because inflation is dead. It's that we may either live in a world where we're accepting higher rates of inflation, like instead of a 2%, we may be more accepting of a 3 or 4% type of inflation rate, just because they don't tighten policy or that much more. And we live in that sort of new, I don't want to say paradigm, I hate that word, but you live in a new structure where people they have to accept more stress or more volatility in their portfolio and daily lives. But of course, that's what the psychotropic drugs are all for anyway. But the yeah, that's a whole different ball of wax. But I think
that kind of ends up becoming this cycle that ends up feeding on itself, right, Bob? Like as you're saying, once we accept more inflation, and let's say the Fed or the Bank of Canada steps back in, lowers interest rates, that begins to devalue the currency, which in turn causes more inflation, does it not?
Yeah. And inflation, the odd thing about inflation is everyone says, literally everybody wrote gold and silver off going into September, October. I mean, you look at the Wall Street Journal and all these economic magazines saying, look, the precious metals are the worst inflation hedge ever. But in reality, gold and silver, there is the real reason why they move is it's not because of inflation. It's because of uncertainty. It's a distrust in the system. You want to really see the metals move. Watch if the election becomes a complete circus in 2024, and people are so fired up because you throw a recession into the mix, which we haven't really seen since 2008. But you throw a situation like you have, like the Egyptian Arab Spring, so to speak, where people lost their job and basically, I think Gerald Salente says it best: when people have nothing left to lose, they lose it. I think that's when things can get really crazy later this decade. And I think you have to have that washout. The problem is this last 20 years of kicking the can down the road was to avoid that ultimate that need for a flush in the system to kill all the malfeasance and all this over indebtedness. I mean, you look at the height of the crypto and everything. If you want to talk about 1929, I mean, the crypto market marked the ultimate in speculation and froth. And it has to be that you have to see that washed out of the system. And that's just one negative yielding debt. I mean, you could go on and on with different types of SPACs and all this other stuff that was created and just got overvalued big time. But eventually, the funny thing is gold and silver, which has maintained itself for 5,000 years, it's like the tortoise and the hare. I mean, it's weird, but it's like people will come back to what they feel is stable. And I think that's one of the reasons why the metals haven't had their ultimate shine yet. You haven't seen the true sort of gold rush or that euphoric moment where everyone is wrapped around the corner trying to buy whatever they can. That's what I would expect to see when we get near tops in the market, is just this vertical launch where the Wall Street Journal, and they're telling us how great it is now at that point. Well, that'll be the time probably start selling. But of course, then the question is, what do you go into?
So could I just follow up with just one quick question? And I don't know if you can answer this in 30 seconds or less, because I know there are other questions. How committed do you think the U.S. Fed is to an inflation target of around 2 or 3%? Or do you think that we're reaching an interest rate ceiling or getting close to it where the Fed might say, you know what, we're prepared to live with 4% inflation? I don't know if you can answer that in a minute or less, and maybe you can't, but I just thought I'd throw it out there as a follow-up, and then I'll go back to the listening.
Yeah, no, that's a great question. Yeah, I think you're kind of right there. I think there's going to be this idea that they can only press on the brakes so much before obviously something's breaking. And you see it with these pensions. I mean, obviously you saw it with the Bank of England having to basically blink when the pensions over there were in dire straits and the pound was basically just going into free fall. I think these central banks realize they can only push so long, and it's really we live in a society of inflate or die anyway. I mean, they can't afford to have a deflationary depression, because not only will asset values and tax structure completely collapse, you'll have a breakdown in social structure as well, and political structure will soon follow after that. I mean, if people buy houses the last 2 years and now they're down because the house prices dropped 20%, they got to make people want to stay in that house. But if the house prices continue to drop another 50%, why even stay in the house at that point? Because you're never going to pay off the mortgage. That's the worry that I've seen for a long time. But they should have let the system cold itself back in 2008 and gone through, take the tough medicine then, but they did want to. And said they wanted to bail Wall Street out. They wanted to have the banks basically become too big to fail. And that's where we are today. And, the problem is, as a metals investor, we're trying to protect. We're trying to be the investor sitting in the corner watching all the chaos in front of us, thinking that, okay, I'm in this thing for the long game. I'm just not going to jump into the chaos. And some people like to trade, but in essence, a lot of people just said, this thing is going to end in tears at some point. I just don't know when. And I don't know when it's going to do that either. I just you just try to watch for signs. I guess was it road signs on the map, so to speak.
I think maybe another couple of points on that, Bob, is watching some of these bigger countries with longer term planning, not this 4-year election cycle type incentive structure in place. But China, India, there's a bunch of countries in Europe that have been repatriating and buying gold and silver, or let's say mostly gold, hand over fist. Those kinds of moves to me speak volumes, because that should be the smart money, right? That longer term money. What are they preparing for? And what is the West not seeing?
Oh, you're absolutely right. I mean, that third quarter report where central banks bought more gold in the third quarter than any quarter since 1967. I mean, if that's not a wake up call, I don't know what is. I mean, these guys are gearing up for some type of counterparty or something that'll build their balance sheet and build trust with that central bank. I mean, you look at the Swiss National Bank, the stock price. That thing is like a tech stock. I mean, it's supposed to be a central bank. I mean, you have to build. Ultimately, the public is going to. You have to build trust, and we've done basically everything to probably kill that trust. Especially the last 8 years or 15 years in politics and I hate to get into the politics side, but you look at this stuff and you see a lot of frustrated people out there. And as the Fed went to a zero interest rate policy from 2008 forward, you basically just destroyed a lot of retirees' portfolios because they were forced to go into and take risk that they probably shouldn't have done. I mean, they couldn't live off a 5% yielding CD. They were forced to go into the stock market or go into some structured product vehicle that was a management fee laden product that Wall Street probably made more on the management fee than they made on the yield. That's a very frustrating thing to watch.
Matt, I'm a futures broker. Okay. So if I just kind of give you a little bit of data that coming into, you had asked about how the inflation might affect the metals or how metals might be affected by the inflation. Coming into the first part of this year, gold is just slightly lower than where it was in January. The front month futures price for gold is February. Silver is about $1 an ounce more now. We came into the first part of the year at around $23. We're $24 and change right now. If I can I'll give you a real brief history, okay? In the year 2000, gold was about $230. Gold is $1,800, okay? I'm not cherry picking that, but I'm going to go back further than that. When your grandfather was young, Matt, if he was in Canada or in America, you could buy a 1 ounce piece of gold. I believe it was 80% pure for $20. They called it a $20, gold coin. Well, that $20 gold coin, Bob could tell you probably off the top of his hat, but that $20 gold coin is probably worth $1,600. All right. So now I'm going to just ask you to think about this. If you had $100,000, okay, and I'm going to ask you to go forward 10 years, are you going to put that $100,000 in a safety deposit box or in a bank account earning 2%, maybe 2%? Or could you buy $100,000 worth of gold or silver in 10 years? I would probably wager that the gold and silver, the $100,000 of that product, would still be worth approximately the same amount of purchasing power as the $100,000 today. I don't know that, but that would be my guess. But you've already, communicated that with the inflation rate in the U.S., it's about 7% year on year. So your $100,000 will be worth $7,000 less purchasing at January 2023 than it was January 2022. So if you think about that a little bit, hopefully that answers what your inquiry was, about how metals might help protect against inflation. Does that help?
Yeah, no, certainly, and I do appreciate that, Jim, and that's good data. That's good data to look at, and I mean, I have, I'm somewhat familiar with sort of the trajectory of gold over the last number of years. I guess the reason why I was asking that is because, and I want to be very careful because I'm a media reporter, so I don't want to give any advice, sure. But from an interrogatory perspective, if you're someone who believes that, hey, I don't think the Fed or anybody's done with interest rates yet, I think that interest rates are going to go significantly higher. I mean, you might have to weigh that against how high do you think the value of gold or silver is going to go in the next 5 years versus what you might be able to get on a certain product that's earning you interest, right?
But please understand that Fed Chairman Powell said the other day, we're not done raising interest rates yet because we're trying to get inflation down from 7. Their target is 2. Now, I'm not sure how they're going to meet their target at 2. He's admitting that we're at 7%. That's what the government data is, the U.S. government data. I'm sorry, I'm not familiar with Canadian data, if it's close to that or not.
It's virtually, it's very close. It's 6.8. Yeah.
All right. So in this last year, your $100,000 is now $93,000. okay, of purchasing power. It's still $100,000 in your safety deposit box.
Yeah.
But you understand. It buys 7% less. Okay.
Yeah. Oh, yeah.
And gold and silver, they have lost less. I think the Nasdaq at its low was down about 28%. The S&P was down 18 or 19%. They both rallied a little bit since then. But gold, and as I mentioned, silver's $1 higher than it was at $24-ish, $24 and change than coming into this year. January of 2022. Gold just slightly lower, just a few dollars lower. So gold and silver have held up better than investable assets in a 60-40 model, 60% stocks, 40% bonds, or vice versa, 60% bonds, fixed income, 40% equities. So
yeah, no, and that's good to know right there. No, yeah, and that's good data right there, and I do appreciate that, and Bob's comments on sort of inflation and interest rates and how it interacts and where best to put your money. So Jim, that was great. You and Bob have both provided some really interesting comments about sort of what I was asking about. How does that sort of fit into the whole picture?
Matt,
that's all really good.
Let me ask you one more. By your picture, I can tell you're younger than I am. Okay. I'm not going to ask you how old it is, but if I asked you that question, if your grandfather, you inherited $100,000, may I please ask, you're a pretty sharp guy, it sounds like, where would you put the $100,000? And your choices are the market, a safety deposit box, or in gold or silver. May I please ask you what you think? It can be a combination, 50-50. You don't have to spend a lot of time doing it. I'm just interested. You seem like a pretty sharp guy, and what your opinion is. Thanks.
Yeah, no, that's great. First of all, my last name is Young, so I like to think I'll be young forever. But I'm not going to answer just because as a media guy, that's certainly a good question, and it's not an unfair question. It's a good question. I don't like to answer just because as a journalist, I want to remain as neutral as possible. So I'm not going to say where I would put my money in that scenario. And I can see sort of the different outcomes there. But I just wanted to come in and ask, sort of based on some data that might potentially support interest rates or inflation going up and interest rates going up, and then also ask based on data that might support interest rates not going up or inflation going down, and sort of the interaction between those data points and the price of metals and gold. So Jim, it's not that I don't want to answer your question. I totally do, but I just kind of, I want to, as a journalist, I want to be the guy that nobody knows what I particularly think. Then I just ask the question.
Can I offer my opinion, please, Matt?
Sure.
Okay.
Yeah, no, I would love to hear your thoughts.
My
Absolutely.
opinion, I've got a pretty sharp pencil. I view a lot of markets day in and day out, all day long, during office hours. Here's the supporting data for my choice. I would take $100,000 and I would take delivery of one futures contract. It's a little more than $100,000 of silver because there's no premium in futures. Okay, Bob's 1,000-ounce bars I think he said they're $1 over. So 1,000-ounce bars would be $5,000 more dollars. I can buy that same product $5,000 less than Bob. Okay, my supporting information is there's something called the gold divided by silver price ratio, Matt, and it is normally, let's say normally between 50 and 70. It's right now at 75. It's been to 110 or so in the last, I think, 4 years. I think silver is very undervalued compared to the price of gold. I think gold's going higher to 2,500 or so, but I think silver should be 30 to 1 right now. The gold divided by silver price should be 30 to 1. And there's a big Canadian chief executive of a big silver mine in Canada. You might know who I'm referring to. He says that silver comes out of the ground at 8 ounces to 1 ounce of gold. So it's only produced at 8 to 1. So I think silver is undervalued compared to gold. So if I had that $100,000, I would buy $100,000 of 1,000-ounce bars and put it away for 10 years. And I believe that's where the biggest bang for my buck would be to protect purchasing power and maybe have a capital gain, a net capital gain. Thank you.
Yeah, no, first of all, Jim, that's great. I think that's interesting. And anytime you guys want to, DM me data or tag me on tweets with data, I love that sort of stuff. And it'd be nice to see sort of more, I'd love to see more media reporters in spaces like these, just because I think it's a great way to learn. But Jim, thank you very much. I do appreciate that perspective.
I just followed you. Thank you very much.
Thanks for your question, Matt. James, you have a question?
I do. It's kind of a lot of it is wrapped around monetary policy and the necessity for interest rates hikes when, I wonder if at its essence, what's causing this? And a lot of people will point to the real estate market, but I think underlying most of this direction or necessity is the shortage that we have of most of our necessities, right? And we see the increase of cost at our grocery stores. We see an increase in cost in most staples. And so that at essence is, why aren't we trying to figure out the logistics behind improving our capacity to either develop new products or access new products to bring to the marketplace? The other thing that clearly sticks out to me is just the reduction in the size of our workforce, especially when I look at the United States. Like, from what I understand, it's close to 50% of the people that could be and should be working aren't, right? Because they have your workforce has just delineated itself. But Jim, to your point, when we talk about this premium between gold and silver, I think it's there for a historical reason. And the historical reason is this. I'm probably closer to your age. And I will say, of all of the people that I've ever known who have either invested in gold or silver, those who have invested in silver have often been left holding the bag, whereas those who have held on to gold have always, at least historically, found better opportunity. And I think that will also be the case because, side story to this, there is always those innuendo stories that we hear about how easy it is to get silver. We see how it can come on sometimes in unforeseen circumstances through different markets. And so I think that's part of the challenge within the silver market play. If you are concerned and kind of a prepper and you think that these are quantities that I the world's going to go to hell in a handbasket and I need some non-capacity the denomination of currency. Once again, if we're at that state, my God, I think we got more bigger problems than trying to figure out if somebody's going to take my loonie and my toonie. But I think overall, if you so desire, and I don't think it's a bad idea at this time, knowing what we know, with especially the Fed dictating or suggesting strongly their desire to push for higher interest rates, that certainly a gold play at this moment wouldn't be a bad idea. The reason if I looked at this a year ago, I would have thought that Bitcoin and cryptocurrency were pulling away some of that market demand from it. But I think now that the public and the retail investors have experienced the questionable elements of cryptocurrency, I think that has drawn a lot of maybe older people or people really concerned about capital to identify with something that's a little bit more tangible, and that becomes the historical favorite of gold. As I say, understanding why the Fed is raising interest rates, I got that. But I just don't understand why more efforts aren't being put forward in how we improve. If there's a supply demand curve, it's not only reducing the desire for people to want to purchase, but why can't we find an improved way to service that marketplace? That to me seems to be, as somebody who is an entrepreneur or a serial entrepreneur, I've always wondered, historically in the past, 10 years back, just think about it. When we used to go shopping as somebody who would source products for our company, if I didn't find it from one store, I went to another store, or I picked up another phone. I imported it from, if it wasn't coming in from Europe, it was coming in from Asia. If it wasn't coming in from Asia, it was coming in from Australia. It was coming in from South Africa. we were bringing it in, right? But nowadays, I think what has really pushed is that there is still a desire by industry. There's a lot of capital in the marketplace. That's the other aspect, right? People aren't feeling that same pinch because I believe that capital has come in basically because of inheritance, right? We've seen a significant demographic shift, and that there has been a huge amount of people who now have monies that they haven't necessarily worked for themselves and have inherited. And so therefore, the pain of losing that money isn't as critical as if it was that in which you actually accumulated. So I think, thank you for letting me kind of go on my little perspective here. But those are some of the things as I see it from the street corner. So thank you for letting me to give my perspective.
Can I reply to James, Tom? Is that okay?
Yeah, Jim. And just to give you a little bit of a teaser, James, I'm going to be talking to somebody tomorrow on the podcast. It'll be out later this week. A pretty big name about this, basically 47% working age unemployment stat that you mentioned. So that'll be coming out later this week as well. Go ahead, Jim.
James, I agree with you that gold has had a better rap than silver has had. And you can say maybe left holding the bag. I would encourage you to maybe adopt an idea that things are changing. And I think the Wall Street silver people have helped educate a lot of people over the last 2 years or so since 2021. And they've got a big following. My contention was, I'll ask you this question. My contention is that my little example that I did with Matt, if you want to double your money in gold, gold's got to go from $1,800 to $3,600 to double your money in gold. To double your money in silver, you only have to go from $24 to $48. And let me ask you this. How high will silver be when gold is $3,600 an ounce? Is it only going to be $48?
And Jim, to that, the issue is that it goes to scarcity of supply, right? And so I think you are well aware of some of the issues that the silver market has had with all of a sudden silver appearing out of nowhere and people starting to really question the validity of that marketplace, right? And so that's why I say I don't know those to be true. But even if they have 1%, even if they have 2% truth to them, the fact of the matter is that story can affect enough the necessity for what gold does more than anything. I'm not necessarily looking for a huge differential of capital appreciation, right? I'm not trying to double my money. I'm trying to stay ahead of inflation and preserve capital.
I understand. My point was just there's a lot of people in America, in Canada, in the world that they're interested in preserving their wealth, but also earning a return on their wealth. I would just hint, it would be my educated opinion or my educated guess that when gold gets to $3,600, when it doubles from here, silver will be probably $150 or $200 an ounce. Well, my opinion is silver can go 5 or 6 times. Gold can go once. Gold can double once. Silver can double 5 or 6 times. That was my, rationale in stating that I think silver is undervalued compared to the present price of gold. Thanks a lot.
I think as well there you're going to have to be nimble and be able to hopefully temper your greed at that point too, Jim, because that seems to be when silver really does make those as we saw in the last 2 cases, make those real volatile spikes. It's pretty short-lived.
I agree, Tom. I was just saying that at $3,600 gold, I was giving a doubling of gold from 18 to 36. Absolutely. I was giving an educated guess on silver. That's all. That's not my forecast. Yep. That would be if then my condition.
Yeah, absolutely. Profitable loser, do you have a question?
No, I was just wondering if I could. I'm kind of new to this whole space of trading and all that, as far as gold and silver and stuff like that. I appreciate you bringing me up on stage, but I wanted to just mention one thing that I figured out on my studies, which may have been, not as much as many, but I don't know if anybody, like I said, I trade, right? So I'm able to trade a gold, indice, or whatever the case may be. But have anybody, there's power and back testing, right? To study these charts. Anybody ever pull up a gold, a silver, and a copper chart, like all next to each other? I mean, they're identical, so isn't really like the move more valuable than the money? Right? So like if you don't really have that much money, okay, I can invest in whichever is the cheapest commodity or whatever it is, and then as that builds, oh, let me go ahead and jump in silver, and then, oh, now let me jump in gold. Regardless, they're all going to the same place. And what I also noticed is obviously, how we see tech like SPX and indices, how they're dumping down too, right? When those tend to dump, obviously the dollar goes up and gold goes up. But if, like I said, if you pull those three charts up, you'll see copper goes up as well. Silver goes up as well. I'm sure if there's a platinum or one of them other ones, it'll be, it won't be the same value, right? Gold will be how gold is like at 1818 right now or something like that. Silver will be at a different price, but the move, it'll look identical. I don't know if that'll help for those who look to invest, or if that's a way to help someone with a lower cash amount to invest in this type of metal first and let that build and probably transfer those into a different metal if that's even possible. Again, thanks. That was just appreciate your guys' knowledge and stuff. I just wondered if anybody ever caught that before.
Yeah, there's I've done a couple interviews around that, but the one that comes to mind, I believe his name is Andy Hosey from Finding Value Finance. He has kind of back tested, gone back and forth, trading back and forth between the metals themselves. So that's all. I know that we went over that in the interview and on his channel as well. So if anybody wants to check that out, that's there. But I think if we don't have any other questions, we can kind of wrap up for this evening. Bob, Jim, Matt, everybody that asked questions, thanks so much to everybody for their time and input. And I'm not sure if we'll do another space this year, but I really hope everybody has a great holiday, and we'll see everybody back in the new year for sure.
Thanks for hosting the space. Really appreciated the opportunity. And like I said, I look forward to the time that you talk about this labor issues, because I think clearly that's a significant issue about how we get our GDP back into a stable position.
Yeah, absolutely. And to me, it seems like a really mind-blowing stat that the real, let's say, unemployment rate is somewhere around 46 to 47% of the working age population in the U.S. And to me, it seems like it can't be that high. But I'm going to dig into that a bit more tomorrow, and that'll be with Peter Schiff. David, is there something you wanted to add before we wrap up here?
Yeah, I was just going to say thank you very much for hosting this wonderful space and your wonderful spaces in YouTube. Honestly, a wonderful resource, and I've been following you for a long time. You've always had extremely pertinent individuals, and so I was just going to thank you for the hard work that you've done throughout the year and the wonderful information you've given out throughout the year.
Well, I really appreciate that, David. I work really hard to do this, and we give it all of our content out to you guys for free, and I do as much as I can to make sure that we bring you good information. So I'm happy and humbled that you find value in it and that you appreciate it, because I know you're definitely present in a lot of these spaces that I listen to as well. So I really appreciate that. Thanks, everyone. Have a great night.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.